Silicon Valley Bank, a lender to some of the biggest names in the technology world, became the largest bank to fail since the 2008 financial crisis. The regulators shut down Signature Bank to prevent a crisis in the broader banking system. The bank's sudden closings have sent shock waves through the tech industry. The stocks of several banks fell on Monday. The sense of panic was somewhat alleviated on Tuesday when bank stocks recovered some of their losses. We know a lot about this story. Why did Silicon Valley Bank fail? Silicon Valley Bank provided banking services to more than 2,500 venture capital firms, according to its website. Silicon Valley Bank kept a small amount of its deposits in cash and used the rest to buy long-term debt like treasury bonds, which is what most of its rivals do. When interest rates remained low, those investments promised modest returns. But they were, it turned out, short-sighted. The bank didn't consider what was happening in the broader economy after a year of stimulus. Silicon Valley Bank was left in the lurch when the Federal Reserve started raising interest rates. The investments looked less attractive as the interest on the bonds increased. Silicon Valley Bank has problems that aren't related to rising interest rates. The bank was unique in many ways. Silicon Valley Bank was focused on the tech industry and started to see trouble when startup funding began to dwindle. The bank had a lot of uninsured depositors, who tend to withdraw their money during turbulence. The bank had to sell some of its investments at a steep discount to fulfill customers' requests. The tech industry panicked and startups ran out of money after Silicon Valley revealed its huge loss. Silicon Valley Bank was in a state of disrepair by last week. The Federal Deposit Insurance Corporation took over the institution after the bank and its financial advisors failed to find a buyer. The takeover put a lot of money in customer deposits. The FDIC is responsible for maintaining public confidence in the nation's financial system, according to its website. The failure of Silicon Valley Bank is the largest since the financial crisis. The Dodd-Frank financial regulatory package was passed in the aftermath of the crisis. The Federal Reserve had to reduce how often regional banks had to submit stress tests under the new law signed by President Donald J. Trump. The Dodd-Frank package may have forced Silicon Valley Bank to better handle its interest rate risks if it had not been rolled back, according to some banking experts. The New York regulators closed Signature Bank on Sunday to prevent the risk of the broader financial system from being risked. The bank provided lending services for law firms and real estate companies and had less than $100 billion in deposits. The bank had some people associated with the Trump Organization. The bank began taking deposits of cryptocurrencies in the year after the FTX exchange collapsed. Most of the customers at Signature Bank had more than $250,000 in their accounts. Anything over $250,000 is not insured by the Federal Deposit Insurance Corporation, so it would not have the same government protection. At the end of last year, less than 9/10 of Signature Bank's $88 billion in deposits were uninsured. Many of Signature's customers panicked and began calling the bank, worried that their own deposits could be at risk, as Silicon Valley Bank's troubles began to spread last week. A person with knowledge of the matter said that Signature saw a lot of deposits leave its coffers on Friday, and that the bank's stock and some of its peers continued to tank. What have regulators done? The collapse of two banks in 3 days has prompted a re-evaluation of the Fed's interest rate increases. The Fed was expected to raise its key rate by half a point at its next meeting, which was scheduled for March 21, 2022. The regulators said on Sunday that the depositors of the bank and Silicon Valley Bank would have full access to their money by Monday, regardless of how much they held in their accounts. President Biden reassured Americans that the financial system was stable and that customers' deposits would be there when needed. The Treasury Secretary tried to assure the public that the American banking system was safe and well capitalized after she said that regulators had been working over the weekend to fix Silicon Valley Bank. She acknowledged that many small businesses were counting on funds being tied up at the bank. Ms. Yellen said that regulators were trying to address the situation in a timely way, and that an acquisition of Silicon Valley Bank was a possible solution. The FDIC started an auction for Silicon Valley Bank on Saturday and was supposed to end on Sunday. The FDIC invoked a systemic risk exception on Sunday to prevent dire consequences for the economy or financial instability. The Fed announced on Sunday that it would set up an emergency lending program to provide additional funding to eligible banks, and help ensure that they are able to meet the needs of all their depositors. Are other banks at risk? The demise of Silicon Valley Bank and Signature Bank highlighted the challenges of small and mid-sized banks, which tend to focus on niche businesses and are more vulnerable to bank runs than larger peers. The failure of one would cause customers of other banks to stop using them. Silicon Valley Bank has a $209 billion in assets, while Signature has $110 billion, which is less than the $3 trillion at the largest banks in the country. Bank runs can happen when customers panic and withdraw their money. Smaller banks rushed to assure customers that they were on sound financial footing. The collapse of Silicon Valley Bank and Signature Bank caused shares of U.S. regional banks to plummet. First Republic Bank was the worst performer on the day. KeyCorp and Comerica both fell over 30%, and Zions Bank fell 25%. Citigroup and Wells Fargo fell more than 7%, Bank of America fell more than 3%, and JP Morgan fell around 1%. The aggregate value of the banks in the index was wiped out last week as the bank index fell 10%. How is this different from the 2008 rescues? Some compared the takeover of two banks by regulators to the 2008 bank rescues. President Biden tried to distinguish between the bank runs that were taken during the 2008 financial crisis, and the ones that were taken to prevent more bank runs. The taxpayers paid for most of the rescue of Silicon Valley Bank and Signature Bank, while the banks paid for the rest. Mr. Biden said that taxpayers will not be responsible for losses. No losses will be paid for by the taxpayers. He said that investors in the banks will not be protected. When the risk didn't pay off, investors lose their money. That is how capitalism works. What do you think about the collapse of SVB? Please comment below. Thank you for visiting Free Market Economy.